everyone and welcome to another short video from our credit guide series brought to you by Elvin Capital, your corporate finance advisor. Today we will continue in our review of basic elements of loan syndication. In the last video, we briefly discussed the basics of primary loan syndication. We looked at how primary loan syndication operates, what roles the various parties play in the process of primary loan syndication, and what fundamental decisions need to be taken by a borrower in the course of primary loan syndication. If you have not had a chance to see our primary loan syndication video, a link to it should appear on the screen right now. We'll also leave a link to it in the description below. So let's take a brief look at how secondary loan syndication differs from primary loan syndication. Unlike in the case of primary loan syndication, when the syndicate of lenders is constituted prior to drawdown, in the case of secondary loan syndication, the loan is only allocated among multiple lenders after the drawdown. So let's see how this is actually achieved. Initially, the whole loan is advanced by a single lender. Although the credit agreement is signed by a single lender, it is structured and drafted as a syndicated credit agreement, meaning that it envisages multiple lenders and also administrative roles such as security agent or security trustee that will be holding and administrating the collateral on behalf of multiple lenders, and facility agent, who will be the single point of contact between the borrower and the syndicate of lenders, will take care of determining portion of each lender on each drawdown and repayment, fix reference rate and calculate interest, and take other administrative action in relation to the credit agreement. The single origin lender will usually, almost by definition, be nominated as facility agent and security agent, or as the case may be, security trustee. From the legal perspective, at the end of the day, practically the same result is achieved by both primary as well as secondary syndication, i.e. the loan is allocated among multiple lenders. There are, however, important commercial differences from the borrower's standpoint. The first consideration being speed of the whole process. Secondary syndication is normally much faster to complete. This is usually due to the fact that a single origin lender usually is the home bank of the borrower, that has long banking history of doing business with the borrower and knows the borrower, its group and its business well. That is why this lender does not require information memoranda, a multitude of due diligence processes and other time-consuming disclosures and checks in order to be able to complete the credit process and provide the borrower with the money. Lenders and their advisors will usually be bound by non-disclosure agreements or statutory duties of confidentiality. However, more parties involved in the transaction, more information memoranda, and other disclosures wandering around the market means more information exchange and thus more risk of information leakage. That is why secondary syndication can often be a viable option in case of financing transactions that need to be kept highly confidential until they are completed, but there is no problem with disclosing them once they have been successfully accomplished. This is often the case of acquisition finance transactions. Second important point to take is distribution of regulatory or refinancing risk between the lender and the borrower. The fact that the lender finances the whole deal that would normally require syndication by itself implies that it would need to get part of the exposure off its books in a short period of time, usually within 1 year. If within this time parts of the loan cannot be sold on the secondary loan market at least at par, the original lender will need to sell them at a discount and take the corresponding loss. This regulatory risk can be flipped to the borrower's part of the table by a contractual provision in the credit agreement obliging the borrower to refinance, at least in part, the loan within a pre-agreed period of time, usually 1 year. The last fundamental point is pricing, as lenders will usually require a premium for exposing themselves to risks associated with funding the whole loan, as described above. This premium will usually take the form of higher interest rate and fees. In addition, the fact that the loan is syndicated only secondarily normally means that proper lender auction process did not take place, which can affect pricing even more adversely from the borrower's perspective. Even though this worse pricing will be partially offset by savings on the arranger fees that would need to be paid to arrangers in primary loan syndication scenario, all things considered, pricing in case of secondary loan syndication would normally be substantially worse than the pricing that could have been achieved by primary syndication. Assuming that all other factors remain constant, the pricing achievable via primary loan syndication should correspond to the price for which the original lender will be able to subsequently sell parts of the loan on the secondary market. And the difference between the two therefore corresponds to the margin of the original lender. How fat that margin will be determined primarily by how much the borrower values the upsides of secondary loan syndication, especially the swiftness and confidentiality, how robust its negotiation skills are, and how diverse its existing banking relations are. In a nutshell, the decision of the borrower to opt for secondary syndication will be, to a large extent, determined by whether the expected value of the risk of not being able to complete the underlying transaction on time and information leakage outweighs the value that the borrower gives up in the form of higher interest and fees. This lost value can be further mitigated by well-negotiated refinancing terms and the borrower refinancing the whole deal by a properly prepared lender selection auction once the underlying transaction is closed and when the borrower is no more under time pressure. At Elvin Capital, we make sure that your financing is structured and implemented professionally and with the best terms available on the market, assisting you throughout the whole financing process, from its structuring through lender selection, coordination of the whole process until successful drawdown. Hope you enjoyed today's video and we'll be looking forward to seeing you at the next one.